Welcome back to Market Day Report. I'm Scott Shelley, otherwise known as the Cow Guy. Thank you very much for joining me today, or us today. And if you've been with us all day, that's great too. And if you want to stay a little longer, at the top 1 o'clock, it's 1 Central, 2 Eastern, the Cow Guy close. We're going to finish out the week on a good note, right? Try to make some people feel better because it's been a bumpy ride, hasn't it? Let's see how bumpy the ride's been in corn. Let's move over there and see corn has been bumpy. Boy, 14.5 cents lower today to 7.83 even. In that July contract, and even the Dees, new crop Dees is off 17.25 cents to 7.21 just waving goodbye to that 7.50 level that we had been looking at for the short term here a little while ago. Soybeans still the same, 19.25 cents lower there. 16.27 is last in that July. Novi new crops off 17 cents to 14.74.5 as we say goodbye to $15 in that contract. How about Chicago wheat? Let's see what's going on there. Chicago wheat's going to be 2.75 cents higher, 11.09 but we had been, 18 cents higher on our highs earlier. And also the lows are pretty far away. So we're pretty much in the middle of the day's range, up 2.5 cents in July wheat to 11.09 even again. And then we've got that March. Go out the deferreds. We put on 4.25 cents to 11.12 in that March contract. So it looks to be quiet right now, but we have had a decent range. Hardwood wheat in Kansas City is actually lower by 3 cents in the July contract. 11.74 is last, and if you go out to the deferreds, they lose less. All right, 1.5 cents lower in that March to 11.75. Spring wheat, Minneapolis, what do you got for us here? Just slightly better. Half cent higher in that July, 12.10 is last. And we've got a 2.75 cent rally in SEP right behind it to 12.08 and then cotton's had a rough go here. It's been trading heavy, and it's real heavy. 449. 449 points lower in the July contract to 144.27. Let's bring in Todd Horowitz. Todd's with Bubba Trading. Todd, thank you for joining the show from Chicago. All right, what are your thoughts here when it comes to these grains? I mean, we've been all over the place, and it's been pretty bumpy too.
You know, Scott, I think this is just almost, you would call it almost a wholesale sell-off in commodities today. We're obviously been very, very, very volatile and very whippy because we've had very thin volume for the last, a few weeks or so. And, with the equities getting hammered yesterday and now they're trying to rally back. But again, this morning, it looks to me, if you look around at all the commodity spaces, pretty much they're down across the board. And I think you're seeing maybe some profit taking, a little fear in front of the weekend. But the grain markets look great. Again, I still stand by that we're going a lot higher. And I don't see any reason that's going to change my mind anytime soon. There's too many factors, some good, some bad, that are going to influence higher prices. And we're not getting into you don't hear in the news other than hear about food shortages. What's that going to do to grain prices when it happens? And it's going to happen based on current information. So to me, this is just a bump in the road. Just another opportunity to step in and buy. If you haven't bought yet, you can buy now.
I think you're right. Not to put fuel to your fire, but we've had some supply chains that they're just not getting any better. And arguably they've gotten worse. And we had another new record high in diesel, and diesel is what the supply chains live on. It's just everywhere you turn, you've got an issue. So I couldn't agree with you more. So let's stay right there. We're going to go away. We're going to pay some bills. We'll come back and talk livestock with Todd Horowitz with Bubba Trading in Chicago after this. All right, welcome back. This is Market Day Report, and I am the Cow Guy. That's a cheap segue into taking a look at these livestock markets. Why don't we move over there so you can see the cheeky smile as I use that little pun. How about live cattle? Well, we're off a little bit, but it's quiet. June is off 77 cents to 133. Even that's 30 cents from the low. So again, I think I called this leaking lower and acting heavy. That's what it is. But it's not decidedly so. August is off 55 cents to 135.47. So limping into the last few hours of trade today. There's not a lot happening there. Feeder cattle. Well, we've got a lower corn board. Are we going to get? Yeah, this is actually starting to look a little bit better. August is up 77 cents in the feeder cattle in Chicago. 175.15 is last. But let's go out to Nove, and we've got $1.05 tacked on there. That's all right. 181.82. So that looks okay. And then let's take a quick peek at lean hogs and see what they're doing today, and they're doing poorly. $2.72 lower in that June contract to 104.35, and that's only about 8 cents off the lows, 10 cents off the lows, folks. So we'll keep an eye on that one for you. July is also off $2.07 to 107.35. So that's kind of heavy. That's a heavy board too. So let's bring back in Todd Horowitz. Todd, can you navigate through these livestock quotes? Tell us what you think, or what's going on.
Well, I think part of it's the sell-off from, just the general commodity sell-off, but the other part in cattle, cattle's been, a little weakish, tried a couple of rallies, but again, this is going to go back to, in my mind, and back to crude oil and back to, listen, distillates are at record highs now. So, these are issues that are going to have to play out at some point. Hogs, I think they're going to, flutter back and forth between where they are. I like hogs better than I like cattle here, just because of the economy and just because of the issues that are going on. Because we're not exactly cheap in the beef trade here now. So I think that you're going to see some pressure here, especially if crude oil continues to go. I mean, we got to almost 111, almost $112 today, which is, again, that's a big penalty for everybody, including the farmers.
And doesn't it kind of cancel out some of these rate hikes that are going against trying to cool off inflation, which basically is energy, because energy is going to be 60 to 70% of our inflation problem?
It already is. I mean, Scott, you and I both know that crude oil should be at $35 a barrel, and we should be a net exporter and supplying the world with natural gas and fuel, but we're not. So, no, the rate hikes are worthless, except that they do put more pressure on the farming community because they already overpay or pay more for borrowing money than anybody else does. So now it's just an added on bonus for them that they get to pay more for something else, not to mention all the rest of the input costs that are so expensive.
Are you forecasting a lot more rate hikes from here? We had a half this week. What do you think's down
I
the
think
pipe?
there will be. I think they're forced. I think, listen, nominal rates, Scott, GDP, CPI minus 10-year is still over 5%. So, that's a negative nominal rate, which is not a good position to be in. They're going to have to be forced to hike. Yes, it's going to put pressure on the markets. It's going to put pressure a lot of places. But until we get people to go back to work and get these fuel costs down, it's going to be a problem.
So, recession or no recession? I mean, that's where you're leading me down this path.
I say we're already in a recession. This is the difference between me and other economists, which I'm not an economist, thank God. I think we're in a recession now. I think that many people are suffering, and the low GDP print and everything else that's going on. I think there's no way out at this moment.
All right. Well, we'll keep that in mind. We'll try to cheer ourselves up going into the weekend. But thank you very much anyway. Todd Horowitz, he's with Bubba Trading. He's in Chicago. Bring it back here to Nashville so I can throw this back over to Suzanne.